I think there's a ton of first-time home owners and even first-time home sellers that have no idea what to do with the equity that they have in their home.
We've seen home prices do one thing, which is shoot straight up.
The best rate isn't always the best deal for the consumer.
Jacalyn, I don't know if this is the right time to buy. I want to wait it out. I think there's going to be a market crash. How would you handle that question?
Waiting on the market to crash is hoping everyone fails. You're not going to be unaffected by that.
Waiting doesn't get you a whole lot in life.
The best time to buy is when you're ready to buy.
In today's episode, we have mortgage expert, mortgage broker, Jacalyn Forleo, and she's going to share with you, her 18 years of experience. And we're going to address questions like, is a mortgage broker actually needed with AI and ChatGPT? How are mortgage brokers actually compensated? What's the difference between working with an independent mortgage broker and, let's say, someone at JP Morgan or Wells Fargo? When is it a great time to buy a house? Is now a great time to buy a house? Should you be looking to refinance? Is now a good time to sell your home? We're going to cover every question you probably have when it comes to homes, interest rates, mortgages, and everything else that you can think about when it comes to your house and how it's leveraged as an asset. Welcome back to another episode of the Financial Leadership Podcast. Super excited to have Jacalyn Forleo, someone that I've known for a very long time, a friend, an advisor, a mortgage specialist on the show to really talk about all things housing market, interest rates, and some decisions and some questions that you should be asking as you're approaching to maybe potentially buying your first home, refinancing your home, or selling a home as you're watching this. How's it going, Jacalyn?
It's good. How are you?
I'm doing great. Happy Friday. First question I want to just jump into this is that we've seen our clients asking, searching online is how mortgage brokers really get paid. I think most people have no idea how mortgage brokers get paid. And then, and can you break it down for us? How do you get paid, and what should a consumer watch out for? And what are some questions you can equip a consumer with as they're approaching to maybe buying their first home?
Yeah. For myself, and I can't speak for everybody because this is the environment the way I get paid has always been the same. So I don't know another way, but for us, we're a banker broker. So what that means is that we do everything in-house at Zenith, and we have access to a multitude of different banks. And so we have the ability to kind of explore other options. And so with those other options, there's going to be different banks that we have access to. And then we just structure the income that the loan officer or the salesperson receives based on that relationship. So I'm straight commission. We get paid by the bank after the loan closes. So for me, the consumer does not ever pay me any money. So it's built into the rate essentially. So there's always like whatever the market rate is, just completely stripped down. We call it raw pricing. And then we build in whatever the compensation is in there. So there was, I don't remember exactly when loan officer compensation laws and policies and stuff went into place. So that changed it. You used to be able to charge a lot of points in order to get paid more. So now if the rate, let's just say the rate's 6.5, if I were to charge you 7%, that means there's more income in the rate, but I can't keep that as money anymore. You used to be able to do that. Now I give that money back to the consumer in the form of a credit. So if you hear like a no closing cost loan or lender credits, things like that, that's how they're doing it. They're building it into the rate. So I'm charging a higher rate to the investor or the bank, and they're giving that money back to me because they're assuming these are mostly 30-year fixed mortgages. They're going to collect interest from you for the next 30 years. So that's kind of how that gets set up. On top of that, there's we call it a fixed loan fee. It's very comparable. I wouldn't say it's the same because the boss would yell at me if I said that, but it's comparable to like an origination fee. So some banks will charge a high origination fee. It's usually like a percentage, like 1%, 2%, depending on the loan structure and things like that, or the client's profile. That cost most typically covers hard costs of doing the loan. So your like the actual manufacturing of the loans, like underwriting, admin, doc prep, processing fees, things like that. Some companies will itemize all of those things out. We just charge a flat fee. So, and it literally, like that money does not ever come to me. That money is just to take care of all the other people who I work with that are going to touch your file. So the questions the consumer should be asking is, Do you charge an origination fee? You can absolutely charge them. Ask them, how do you get paid? And then do you guarantee your costs or your fees? Because what you don't want, and what we still see, unfortunately, is a lot of bait and switch scenarios where the lender might present this option. And then when you say, oh, okay, yeah, let's go with that. And then when you actually get your loan estimate, they're like, well, we changed this and we had to add in this. And now you're kind of stuck. So we guarantee our fees, which just helps keep the consumer in control and maintains that transparency. So the client always knows what they're paying and that it's never going to be more than what they think it is. So those are probably the big questions I'd say to ask up front is how are you paid? And then do you guarantee your fees, or can you give me like a really good estimate? And then if you can't guarantee the fees, I would ask why. Because manufacturing of a loan does not, like, it doesn't vary. It's the same.
Okay. So that brings me to another question. And, I've personally have used you. And what I love about the way that you approach working with a potential client is you're very consultative. Like, you give them multiple options. You've actually talked me out of a couple scenarios. I know a handful of our clients have used you, and we get a lot of great feedback. Why would a client, or what are the advantages of maybe potentially coming to you? Like you said, Zenith Home Loans, independent, multiple banks, versus going directly to like a Wells Fargo, JP Morgan, or like a big bank?
I'd say, the biggest difference is going to be just like what you said, like a multitude of different options. So like not every client fits into the same mold. So like a Chase Bank, for example, they have these 6 products. And so for me, I have Chase's 6 products, but I also have Wells Fargo, PennyMac, all the rest of them. So if you don't fit into this mold, then it's like, okay, that's fine. We can go on to the next one. Whereas if you went directly to a bank and you don't fit into their mold, you can't get qualified, you have to then go find someone else. So I think that's the first thing. I think also just the flexibility in being able to not necessarily negotiate, but like explore all of your options. What I typically will see from one of the larger banking institutions is because they have just their products to sell, there's not a lot of room for creativity for some of the more challenging profiles that some clients might have due to a multitude of maybe credit situations or employment situations, things like that. So I think it just gives you a lot more flexibility. And then like we're really on the consultation side of the spectrum. So I think coming in and being able to have a very dialed in conversation around what are your goals. I'm not saying these big banks don't do that. I've just never heard of them doing that. And so I think as a mortgage consultant, which is kind of how I frame myself, I'm not just looking at today's loan. I'm looking at, okay, today's loan's going to spearhead our ability to take on to the next one. So I want to make sure that whatever we do today won't derail what we want to do in the future. And then because I work with a lot of your clients, and I work with a lot of clients who have financial advisors and other people in their world that are trying to make sure their long-term wealth is paid attention to, I also want to make sure that I'm not doing anything with today's loan or even the next 3 that could derail any kind of long-term savings plans that they're setting up. So we want to make sure that it's like a very cohesive, holistic approach to what's the long-term play. It's not just today, it's all the way down the line.
Yeah, I'll just speak for my own experience. Christy and I, we were using a certain individual for a long time. He's a great person. I think he did his best, but he was with Wells Fargo. And then when we started working with you, just a totally, completely different experience. So as you just said, mortgage, when you get a mortgage, sometimes it's transactional. But what I've noticed, and I've had my clients say this to us too, is like they actually hear from you, even though that, that loan may be in place 2, 3, 4, 5, 10 years, whatever it is. Can you talk a little bit about your, service model, which to me, I actually call like a hospitality model, your interaction post close, you take things completely different. Can you talk a little bit about that differentiator and kind of how you follow up with clients and stay in touch with them?
Yeah. I really think at the end of the day, it's about the relationship. So, I've been doing this. I'm coming up on 18 years. I plan on doing it for at least another 18 because I just enjoy the relationships that I can build with people. And so I like getting to know the client through the course of the transaction because I'm going to know absolutely everything. And then a part of the follow-up is okay, so we got you into debt. Now, how do we get you out of it? So I got you into this mortgage. We got you into the higher rate, or you did the 2-1 buy down, or whatever the case may be. Now, how do we make it better down the road? Because you're going to be building equity. So as soon as you close on that loan, I'm looking for a refinance opportunity. And so go, okay, here's what the market's doing. We're always going to have a target rate or a target payment savings or whatever the case may be, depending on your profile. Usually after the first year, we have a pretty good idea of how long we can actually be in this house. So it's like, okay, now we've been here for a year. What are we thinking? When we bought it, we said 5 to 10. Is it still 5 to 10? Or is this yeah, it's fine for right now. I want to get the payment as low as possible. I want to turn this into rental. And it's like, cool, here's how we do this. We want to start setting up all of that stuff on the front end. And I've become really good friends with some of my clients, which has been really, really fun. And when I start to get to do deals for my clients' kids, makes me feel very old, and I'm not sure how that happened, but just getting that opportunity, I'm just like, oh, this is really fun. So just kind of getting to see like that first home, and then what that catalyst turned into for them becoming real estate, like building out a real estate portfolio, or being able to buy their dream home, or that dream renovation, or getting to pay the loan off way sooner than you ever thought you could because it's your forever house and things like that. So getting to know them, like it's not transactional to me. There are definitely, there's some clients who don't want that. I still try, but I'm just like, no, I want to be your friend. They're like, nah, we're good. You're just the banker. I'm like, all right, well, the next guy will. So it's fun. It's a big deal. Buying a house is a big deal. It's very scary. It's very expensive. And if we do it wrong, I could completely screw you over. And so I want to make sure that I'm not doing it wrong. And then even once we get you in, I want to make sure that you always have a point of reference, because your loan, we don't service our loans. So you're going to get passed over to another servicing company. And that always freaks people out. And they're like, well, and I go, I'm still a point of contact. I'm not servicing the loan. There's going to be some information I don't have access to, but you can absolutely always, always, always call me. Like prior to this call, I was on a call with a client whose loan I did not do when he bought the house. He's like, I want to look at a refinance because I want to save our payment. And I was looking at his mortgage statement. I'm like, okay, you're at 3.25. Do you need debt consolidation? He's like, no, it's just his taxes and insurance have gone up. So what I thought was going to be a cash out refinance conversation turns into we need to find you a new homeowners insurance policy because this one's way too high. And then we need to go back to the mortgage company, and which was never me. So I'm getting paid $0 to have this conversation with him. But his house payment's gone up like $700 a month because of an escrow shortage. And he didn't realize that that's what was going on. And so now it's like, okay, we have this conversation. Now I can act as a consultant and an advisor. And being able to like kind of calm some of that is something that I really enjoy being able to do, and just show them, be like, no, we don't have to do a cash out refinance to fix this. Like we can just get you a new insurance policy. Here's kind of what the breakdown is. I'm going to shop around some insurance companies for him. And like I said, he is not my client. He was not my client. He just was referred to me by somebody else because they thought he needed a refinance. And then being able to have that conversation, like I'm not just in it for the paycheck. It's about helping the consumer. It's about helping that person build generational wealth. And I can't do that if I'm only looking out for myself. So being able to kind of go through it and have a very crystal clear and client-focused conversation with them about here's what's best for you. I'm not going to talk you out of something if you think you still need to do this thing over here. I'm just going to tell you why maybe it's not the best idea. And just make sure you have all of the information available to you to make the very best financial decision based on your current situation. Because just because I say you should do something doesn't mean you should. Just because I say you can doesn't mean you should. Same thing with you. When you guys are advising, you're like, here's where I would put your money. And it's like, oh, just really uncomfortable. It's like, cool. This is what I would do, but let's revisit. Like, there's no pressure there. There's just like, this is just conversations. This is making sure you're educated, because we don't teach this stuff in school. And so people don't know. And then a lot of the information our parents and our grandparents have is so dated that it's just not applicable anymore to the current situation where everybody's in. And we're in these $600,000, $700,000, $800,000 houses and 2% interest rates. And we're like, okay, well, so what do we do now? And if the payment's too high, like, how do I fix this? And people get into debt trouble, and people make some really poor financial decisions, and they don't have anybody to guide them. And so being able to do that is really part of that relationship building. And I think if I didn't have the relationship with the person that referred him to me, he might have ended up with somebody who just refinanced him and took his rate from 3.25 to 6 for no reason.
Right. Oh yeah, no, I read about it all the time. I love that saying, I got you into debt. how do we get you out of it? Maybe that's a shirt that you should make. And then once the home closes, they get that shirt and then that sparks up a different conversation. Right? Good marketing idea. I get this question a lot in my world, right? Stock market's at all-time highs. We haven't had a market correction, a true market correction in the market since 08, 09, a housing market correction in 2008, 09. And, when Christy and I moved out to Colorado in 2005, bought our house in 2006, at that time, home prices were at all-time highs. So we lived through an 08, 09 correction. And the question I have is a lot of people are wondering if the market is going to crash like it did in 2008. And when you're sitting across from clients, do you hear, or are they asking you, is this the time to buy? Because, I think a lot of people feel that maybe, or maybe that it looks like to me like the housing market's coming down a little bit. But, when someone were to ask you, say, Jacalyn, I don't know if this is the right time to buy. I want to wait it out. I think there's going to be a market crash. How are you dealing with that question, or how would you handle that question right now?
Do you want my professional answer or my smart ass answer?
I want both. I want whatever answer you want to give us.
So, if you think about it, waiting on the market to crash is hoping everyone fails. And if the market's going to crash, you're not going to be unaffected by that. You might lose your job. There's a bunch of things that are going to have to happen for a market crash. The reason why this is not 07, 08, 09 is because that was a supply and demand situation as well. There was a ton of houses available and there were not enough buyers. Now we have a housing shortage. Here in Colorado, the inventory's definitely gone up, but there's still a shortage. And so with the clients who are on the fence, and I have a lot of clients who are waiting on rates and things like that, the conversation is the best time to buy is when you're ready to do it. Doesn't matter what the media says or your cousin or any of that other stuff. The best time to buy is when you're ready to buy. And so if you're waiting for rates, what I will tell clients is right now, as we're recording this, September 2025, the rates are doing better. They're still on the higher side, but we're starting to see improvements. When interest rates go down 1%, 5 million qualified buyers enter the market. Not in Denver proper, but 5 million, because if the rate was 7 and you didn't qualify. But now the rate's 6, I qualify now. So everybody that you wanted that $600,000 house and you qualified at 7, but you wanted to hold out for rates. Well, now the rates have dropped and you're more comfortable on the payment, but now so there's 5 million other people. So now there's more competition. Competition drives up prices. Now you have to waive contingencies. You have to have no contingent offers on, if you have a house to sell. You're waiving appraisal deadlines. You're waiving appraisal waivers. So you're covering the difference. And so that's what we were seeing in late 21, 22, 23. And so that's why we saw what we did. So right now, what I'm telling clients is if the house is 500 today and you want to wait until next year to buy, so let's say the rates drop 1%, the payment's probably going to be about the same, even though you've got a lower rate, because that price is going to go up. So if the price goes up 50, 60,000, whatever it is, you've waived all the contingencies, your down payment's now higher. Yes, you have a lower rate, but you're paying back a higher loan balance. It would make more sense, if it makes sense for you today, to buy the house today and buy it at today's rate. And then next year, when those rates come down, you're already in the house and you let the feeding frenzy happen, push property values up a little bit or back up to where they're supposed to be, whatever train of thought you want to be on, and then be able to refinance. Because I can't change what you paid for that house. You paid for that house what you paid for that house, but I can always change your rate and I can always change your payment. So again, this time of year, especially right now, there's a lot of really good deals out there for clients to take advantage of. And if you are in a position where you can buy and that is a goal, you should absolutely consider doing it right now before the rates come down any further, because you are not the only person on the fence. That fence is drooping. There's so many people sitting on it and they're all going to come into the market at the same time. And we're going to see those, the bidding wars and all that stuff. We're already seeing it. Okay. It's just not on every single property.
Right. It's on certain products. So Next question I have is, where do you, and of course we're not going to hold you as gospel, where do you see rates in the next, 1 to 3 years?
I thought that it would be lower by now. Everything that we're seeing from all the different market analysts, which are just guessing, really is just they'll start to come down. I think they'll probably stay, they're like mid 6 right now. I think they'll probably stay about there, maybe get down a little bit closer to 6. I think next year rates will probably start coming down. I think we'll probably see a 5. We're not going to see a 3. It'll be in there. It's just not going to be at the first part of that interest rate. Like those, the 2 and 3% interest rates, like those were not real. That was super duper clearance, end cap. Once it's gone, it's gone. Like that's what that was. And so what that's created now is a lot of people who want to move or should move because they've outgrown the house, they don't like the neighborhood, whatever it is. They bought the house sight unseen and they're afraid to because the rate, they're like, well, but I'm going to go from 2 to 6. And I'm like, but you hate your house.
Right.
Move, go, bye. Move on to the next one. Because it's about, I would worry less about my rate. And I know this is really hard for everyone to hear, I'm sure, especially if you have a 2 and you're going to a 7. Worry less about the rate and worry more about your total monthly output. Because at the end of the day, no one cares what your rate is. Like, it's just, what's my monthly output and what am I comfortable with? And that's really, I think, what it comes down to. I think that's where the media has got us all screwed up, amongst other things, is just focusing so heavily on the rate. I think some people in the market, they're like, just get the best rate, get the best rate. And I'm like, the best rate isn't always the best deal for the consumer. And so I think coming from a perspective of making sure that you are comfortable from your monthly output, and sometimes that means putting a little bit less money down and paying off another debt, and just having a more strategic conversation around that piece, I think that makes way more sense. Because what consumer debt's up, like there's $1 billion in there, isn't there? Like $3 billion or something like that.
No, it's up.
So like that's not good for anybody. Like if you have a 2.5% interest rate, but you're paying 36% on a credit card, you're not winning.
Right.
You're not winning. You're not getting any tax benefits to a 36% interest rate on your credit card. And you're not there. You have tax benefits with your house. So there is a strategy in there. You just have to be comfortable enough to let someone advise you on how it works and then build the plan from there.
Yeah. What you just explained, in your answers, we bought our first house in 2002. And our interest rate was 6.5. When you're telling your whole story, I was just thinking about, and, we got into the house, outgrew it super fast, didn't love the neighborhood. And that's when we actually moved to Colorado, bought a bit more expensive house. Interest rates were similar, but we loved the neighborhood. And then we've seen interest rates go from 6.5 to 2. I think if you're watching this, most people don't stay in their first. I think it's very rare. Maybe you can correct me because you're dealing with a different I know you deal with all different type of age groups, but we haven't stayed in one house for more. Our house right now we've lived in for like 10 years. That's the longest. I've been a homeowner for 23 years. It's the longest we've ever stayed in the house. Do you think people get caught up too much in like when they see their first house, like it's got to be perfect, it's got to be this, it's got to be that, and just not, because like you just said, get in the house. Yes, there's a chance you can live there, but there's probably a chance that you're going to outgrow it. You want to move in a different neighborhood. You start making more money. You want to talk a little bit more about that?
Yeah, I think, people don't stay in their houses for 30 years anymore. There's your grandparents or your great grandparents, they might very well still be in the house that your parents grew up in. But that doesn't happen anymore. And so what I think people forget is real estate is the long play. You're not supposed to be able to buy a house and then 2 years later turn a $200,000 profit. Like that's not normal. So those massive property appreciations that we were seeing, like that was just market driven. That was supply and demand. That was 2% interest rates. If the rates had been 5 or 6, that would not have happened.
Right.
And so I think the other thing that screws us up is everybody focuses too much on all of the BS on social media that makes it look like people have these like really fancy houses and the granite countertops and the stainless steel appliances and all these things. And they think that their first home needs to be their dream home when like your first home should just be your first home. Like I can't get you into the real estate game if you don't buy that first house. And that first house can be a $400,000 condo. Like you have to start somewhere. You just have to get your foot in the door. And then once you're in, then you can start leveraging that. And so I think too, most people don't stay in their interest rate. I mean, these 2 and 3% interest rates are definitely an anomaly from that perspective. But for the most part, there's a refinance scenario that could make sense every 3 to 5 years. I think the longevity of a refinance or a loan term for most people is between 5 and 7. And then most people move every 5 to 7 years as well because of all of the things you described. My family grew, my family got smaller. I don't like the neighborhood anymore. I need to move for a job. We're fully work from home. That's not really a good place in this house. There's not a good spot for that. I need my own office. Like there's lots of pieces in there. Like my first house, I paid like $156,000 for it back in 2010 with an FHA loan, 3.5% down. Mom and dad gave me the down payment. I still own it, but I lived there for like 9 years. And I was convinced I'd live there for 2 years and then I'd sell it and I'd move on. I still own it. It's a rental now. The couple that's been living there, they've been in there the entire time I've moved out. And then we've moved only 2 other times since then. The house we're in now, we bought in 2019. And that is, I call it my forever home. It's really until I can't go up and down stairs home because there's no way to get into my house without a staircase. And at first I was just like, no, this is fine. And then I saw some grandparents and I'm like, oh crap. You can't get to the main level of this house at all, either from the front yard, backyard, or garage without some stairs. I'm like, all right, we're going to have to move at some point. But I can stay there I think we'll be there at least until our kids graduate from high school.
Okay. Good.
So, but I think people think the first house needs to be the perfect house. And that's not how it's supposed to be.
Yeah,
You're supposed to build the equity. You're supposed to put that sweat equity in. It's supposed to be kind of gross and you clean it up.
Oh yeah. I mean, our first house, 12 months into it, we had these 2 nasty palm trees in the backyard. And when we cut them, 2 nasty raccoons fell on the ground. This is daylight. I screamed at the top of my lungs. I was like, I can't believe raccoons. And they could have eaten my kids. What about home price? You talked about interest rates. What about home prices? Are you seeing them come down a little bit? Do you think they're going to soften up? Or, we really haven't seen, we really haven't seen, I haven't, since 08, 09, we've seen home prices do one thing, which is shoot straight up.
I think they need to come down a little bit. I think there's some realistic sellers and there's some unrealistic sellers. I think there's some sellers that don't really need to move, but it would be nice. And so they're like, no, we're going to price it as high as we can and we'll just see what happens kind of thing. Or sellers who don't want to fix anything. And so I think that's where the big shift has been in the last 6-12 months is we're seeing price reductions, which is great for the consumer. And as long as if you go back and you look at what the loan balance is and then what these people are selling their houses for the most part, I'd say 90 to 95% of people are making money off of the sale. So it's not like with the price reductions that you're seeing that people are going to be upside down. Like that's not what we're seeing. And I think that's what we saw early 07, 08, 09 is people were upside down in the homes. That's not what's happening now. What's happening now is some sellers are pricing the homes as though it were 2021 and they're sitting longer and they don't want to do these price reductions. So when you see these massive price reductions of like 100,000, they probably priced it too high given the market anyways. But no, those people probably don't have a big loan on there. So it's not like they're losing money. Of course, I want to sell my house for $1 million. Why wouldn't I want to make $750,000 on my house? Anybody would take that. But is it realistic for the market? Probably not. And so that's where, as a consumer, as a buyer right now, you have the flexibility. And that's why this is also a great market for a buyer to be in, is because we haven't seen something like this in years, where as a buyer, one, I can take my time to pick the house. You're not in line to go in and see it with 37 other people and having to make an offer before you even step in the door. You can kind of take your time. You can go back to the house a couple of times and just like double check and triple check and measure the family room and will the couch fit and all of those things. And then you can go to the seller and be like, hey, I want a $10,000 concession or a reduction in price, or I want you to fix these 6 things that came up on inspection. My buyers who bought in 20, 21, and 22 did not have that opportunity. Those are the ones whose the values have stayed fairly stagnant, and it's because they bought at the top of the market, which that happens. Like that happens in every aspect, like in every different industry. It's like there are going to be times where you end up in the top of the market. But again, this is buy and hold. This isn't buy and flip it in a year and hope for $100,000 profit. Like you need somewhere to live. And like, you should just assume when you're walking into that house, I'm probably going to be here for 3 to 5 years. And then the appreciation is really only supposed to be like, traditionally in Colorado, I think its average is like 6 to 7%. But nationwide, I think it's only like 3 to 4%. So those 18 and 20% property appreciations we were seeing for a little bit, like that was never going to be sustainable. So the fact that things have started to come down is actually a good thing because it makes it affordable for people. Like, I don't want to live in a state or a city where no one can live here. Like, that doesn't make sense to me. Like, my first-time homebuyers can't live here. And that's what it was doing for a little while. Like, I had a lot of people who are like, yeah, we can't afford to live here. We're moving to Kansas.
Oh, no.
And I'm like, crap.
I'm sorry.
Why Kansas? I'm sorry for everybody who lives in Kansas. I'm sure it's a beautiful state. So it's got to be good for everybody, right? Like it's not good for me and too bad for you. Like we can't pull the ladder up from behind us. Like everyone deserves an opportunity to get into a property. Like we can't all be just like these money hungry, greedy conglomerates trying to take over the world. Like people need to be able to live and like raise their families and not live paycheck to paycheck. Cause like that's not good for the economy. It's not good for anybody's mental health either.
No, that's great. And I'm glad you brought that up because that's going to segue into my next statement. You mentioned something, and my clients that are watching this, subscribers are watching this, I know some of you are from Kansas City. We love to visit. The Chiefs are playing tonight, and I agree with you. Hopefully they lose. It is football season, so we can talk a little bit of football. So even though interest rates are a little bit higher, you're seeing house prices come down a little bit, and that gives a little bit more power to the buyer. So if you're watching this and sitting on the fence, you actually could be missing a unique opportunity to have a little bit more asking power when you're going to a house. And like you said, you can actually visit a house 2 or 3 times. Yeah, I heard a lot of stories during COVID where like you helped one of our advisors buy a house and they were getting outbid, and then they finally got the house they wanted and he's already outgrown it. So they're going to stay there at least for a couple of years, and then they're already thinking about looking at other stuff. So ladies and gentlemen, waiting doesn't get you a whole lot in life, because if interest rates come down, like Jacalyn said, then you're back to fighting with a lot of other people. And that is super stressful and emotional. Like we haven't even talked about the emotional side, taking all that time and energy to look for home after home after home, and just know that you're getting outbid by someone else is pretty deflating. You just talked about, let's talk about the home as an investment. And you've always, I think we've always been told your best long-term investment is buying a house. If I look at most of my clients to have the most amount of wealth, not all of them, but a lot of them have a pretty substantial real estate portfolio, because like you said, they bought these houses 30 years ago when they were $50,000 or $75,000, and they don't have, and their investment is, 10, 20x. For people that are looking for homes today, would you still say your home is the best investment you'll ever make? And where is that a yes? And where could that be a no if you're not careful?
I would say 100% yes, because you have to live somewhere. And so why wouldn't you live somewhere where you're paying, like you're not paying yourself, but you kind of are? Because like with every single house payment, you're building equity. And the longer you stay in the house, then the longer we pay down that loan, and the more property appreciation we have, and the likelihood that you're going to make some renovations to that house, you're going to improve the value and all the other things, you're going to create equity. And with that equity, there's a ton you can do with equity. So, and that's something that I don't think we talk about enough at all. I think there's a ton of first-time home owners and even first-time home sellers that have no idea what to do with the equity that they have in their home. And so I think that's a total miss on my part for sure, but on our industry and just financial industry in general. And so I would say that, yes, again, I'll go back to what I said previously, that if it makes sense for you to buy right now, then you should absolutely do it. Because there is something from a mental and emotional standpoint of knowing that this is mine. I did this. I made this happen for me. And the catalyst of what that can create for the rest of your family. Now, where can it go wrong? If you treat your house like an ATM, if you don't take care of the house, if you stop making your payments, you go into foreclosure, like all the things you're not supposed to do. So if you don't feel like you're financially, financially responsible enough to buy a house, then don't do it. And if you don't, just like, no, I would rather just not be responsible, that's fine. There is nothing wrong with being a lifetime renter. Just know that you're letting go of some tax opportunities as a result and the wealth building. And so if for anybody that's considering it, at least have a conversation to know what do you have access to. Like there's low down payment options. There's veterans who don't realize they have 0% down options. There's down payment assistance. You do not need to be a first-time homebuyer to use it. You don't even necessarily need the down payment assistance to have access to it. As long as you fall within the income requirements, you can use it. And what I've used down payment assistance programs for clients is like, let's just use it to not wipe out your savings. Because we found a house that was a little under where we wanted to be on the max value. So it needs a little bit of work. It's like, cool, let's supplement your savings. Let's not touch your savings. Let's use down payment assistance, get you into the house. Now you have that cash to do your renovations, to buy the new couch, to whatever you're wanting to do. And so I think that's the biggest piece of it. I think it's you can't build generational wealth without a big wealth driver. And I think a house is probably one of the best ways to do that because your costs are more fixed. You don't have rent going up all the time. You might have more like home improvement type things, but like I wouldn't say, unless you buy a true fixer-upper, that's like Tom Hanks, The Money Pit. What was that? Is that the name of that movie where he falls through the floor?
That the money? I'm not sure. Yeah, I think I'm looking at my producer. Was that it, you think?
Lord, that is a funny movie if people watched it.
All right.
He puts a big rug over this giant hole in the floor and he like falls to the floor. And I'm like, does that happen, Dad? And he's like, no, that's not. I was like, oh, okay. So I think being able to just create that and creating that stability, I think too, for your family, I think that's important too. I think that takes a lot of stress off of like, where am I going to live tomorrow? And what if they raise the rent? And I've had a lot of clients who are like, yeah, my landlord called me and they're selling the house. I need somewhere to go. And it's like, they don't have anywhere to go. And so when it comes to the actual equity, there's a lot you can do with your equity. Like you can use it to leverage the down payment on the next house. You can turn this house into a rental property and do another small down payment and buy the next one and keep doing that and just keep turning them into rental properties, which a lot of my clients do. That's that house hacking principle. If I have a client who had a bunch of really serious medical things come up in the last 2 years and they had a really low interest rate, but they were like, the amount of debt they had was nauseating. And they're like, we don't want to let go of this rate. And I'm like, even though I took their rate, they were at 2.625. I took them to 7.625, but I reduced their monthly output by $1,500 a month. And we wiped out 100% of their debt.
Wow.
And so, yes, we exchanged a low rate for a higher rate, but with the equity they built, we undid all of their stress because I got rid of 100% of the debt. You can pay for college. You can go on a family vacation. Like you can invest. You can start your own company. Like there's a ton you can do with the equity. But if you don't own the home, you're going to have to just work as hard as you can and make all the money and make sure and hope that you made really smart financial investments into the market, which no one can predict that either. And like, if you have an off year and all the money's gone, because I've got a client like that too. Okay. He's like, yeah, all the money I invested is gone. And it's like, you put all of it in there. And he's like, well, yeah, can't we refinance again? And I'm like, no, we can't. Like, there's no more money left. You used it all. So that's where it's like, you can't use your house like a bank. It's not a bank. And you've got to be smart. If you are going to do something, if you're going to pull the equity out, anytime I have clients who are pulling equity out, I'm like, what are we doing with it?
Right.
And where are we, or if we're saving payments, like, what are you going to do with the savings? Like I turn into my dad. Like, what are you going to do with it? I need a book report. I need you to tell me exactly where it's going to go. But because I don't want somebody, I don't ever want a phone call, and I've had them before, but I don't want a phone call where a client's like, yeah, I shouldn't have bought this house, or I know all the debt we got rid of the last time we did a refinance. Well, it's back again. And it's like, and there will come a point where I cannot help you anymore. And that's a terrible conversation.
Right.
And I've had that one too. And it sucks because money's really freaking stressful for people. And it doesn't need to be.
Yeah. Tell me about it. We talk to people all the time. It's a lot of discipline, but what I like about how you approach what you do for clients is just not, hey, here's a rate. Good luck. We'll see you next time you want a house. It's really a high level consultative approach based upon goals, needs. What other things do you think you're going to have? Debt consolidation. I love the story that, people get so fixated on the rate. They have all this other debt. And then you help someone clear up $1,500. And if they wanted to, they could, like you said, invest it, or they could even pay down their mortgage a little bit faster. I mean, there's so many things. In the most simplistic term, you mentioned tax savings. Imagine that I'm a first-time home buyer listening to this episode. Jacalyn, how does buying a house help me with my taxes? How does that work?
I am not a licensed tax prep person. It's full disclosure. That is not my job. I have zero qualifications in there. However, mortgage interest and property taxes are tax deductible. So if you are used to getting a little bit of a refund every time you file your taxes, or you usually owe, there's a very good likelihood that that's going to shift. And so you get to write some of that stuff off. And I think if all of the other big billionaires get to write off stuff, you should have that opportunity too. So you don't get to write off anything on your rent. You can't write off your car. You can't write off, in certain situations you can, but like you can't write off the interest that you're paying on a credit card. You can write off the interest that you're paying on a mortgage. So that's where I try to tell clients, and I'm like rates are so high. And I'm like, silver lining, higher tax write-off.
Right.
Do we want to it's the best way to look at it, but it's like, yeah, it's a tax benefit. I think I'm pretty sure, and I need to look up the article and I can send it to you, but I'm 90% sure something went into play fairly recently that mortgage insurance is going to be tax deductible again. So I think that's coming back because it hasn't been for a little while. I know there's a bunch of ways that your property can become tax deductible. If you're 1099 or self-employed, you can write off part of your house. So you can write off your expenses, you can write off your utilities, the space in your home that you use for your work from home. If you're W-2, you can't, but if you have like a consulting business on the side, there's a lot of opportunity in there.
You just gave me a good idea. A really good idea. I think this is a good idea. Of course I do, because I just thought about it.
Well, what is it, sir?
Yeah, I'm going to say it. And I'm going to have Amelia reach out to you and some of our other referral partners like Deanna, who, helps our clients find homes. Our Medicare expert is, if you would send us maybe one good article a month for our newsletter. We send out a newsletter every 2 weeks. We could, feature you, and you could help us come up with more, just not, David's or Max's financial content, stocks, the stock market, this, that, or whatever. But we could start including, stuff on homes. I'll shoot you an email, but I'd love to get like a real high level article from you once a month. And then we can feature the article and you in our newsletter. So that was my idea. Bing, bing, bing.
Yeah.
Yeah, it's a good idea.
Love it.
Yeah, for sure. We're always trying to promote others. All right. Myths. Let's talk about first time home buyer myths. When I first bought my home, I always was told that you had to put 20% down. And when I actually bought my first home, that wasn't the case. In fact, and this was in California, we actually put $5,000 down. And 2 years later, we did sell it and make like $300,000, which I thought that was the way it was. But now that looking back on it, those are just crazy times. What are some one or two myths and fears that you see that first-time home buyers have that are not true? And then I want you to back that up with, what are some of the top unique loan options? Because your industry is no different than mine. Our clients' needs change, their dynamic. And, our industry has done a good job of, being able to come up with strategies, products, planning scenarios to help our clients achieve the most with their wealth. What are some unique after you answer the first question, what are some unique loan options that you've been using over the last couple of years that maybe some first-time home buyers or people that are watching this don't even know exist?
Yeah. I think the first one's definitely the 20% down myth. I still hear that, which blows my mind, because I'm like, how is this still circulating? So, the big thing with the 20% down is when you have 20% down or more, you have no PMI or private mortgage insurance. Now, a lot of people think private mortgage insurance is bad. And why that's not the case, and what I will tell clients is mortgage insurance, it's a leveraging tool to avoid having to put down more than the minimum. And so using it and looking at it from that perspective and taking it from like, this is a leverage opportunity. The mortgage insurance protects the lender, me in this scenario, from if you're going to go into foreclosure because you're technically a higher risk. So that's why there's mortgage insurance on there, because you're putting a low down payment on there. We're going to add mortgage insurance so that way if you go into foreclosure, the lender can be made whole. Okay, so that's why that exists. There's some other benefits within the mortgage insurance. So that's like kind of the overall simplified version of what that is. But what happens is like I can't do this kind of math in my head. Hang on a second. So if it's like a $600,000 loan, we're going to do 20% down. That's $120,000. If I do 5%, that's 30. Did I do that right? Yeah, 30,000. The ability for a consumer to come up with 30,000 versus 120 is substantial. And so now if I'm going to wait until I can save up 120 grand, that $600,000 house might now be at 850, depending on what my savings capabilities are, or falling into some wealth waterfall or something like that. And so the mortgage insurance is typically fairly inexpensive in the grand scheme of things. And if I can pay an extra $100 per month on payment to not have to come up with an extra $90,000, that's a no-brainer.
No-brainer.
So I think that's the big piece in there, is just understand, what is not putting 20% down do for me? Can I pay off some debt? Can I have some emergency savings available? Can I not finance my car repair? So that's where, again, it comes down to your monthly output. I hear a lot that FHA loans are bad. They're not. They're awesome. They are built for a consumer who is likely a first-time home buyer, but not necessarily. Somebody who has newer or limited credit, or maybe beat up credit. So it's a great opportunity for somebody who found themselves in a situation where maybe there was a foreclosure or a bankruptcy. This allows them to get back into the market. This allows them that second chance. If you have lower credit scores for whatever reason, an FHA loan might make a lot more sense. It might significantly reduce your monthly payment. So the people who are out there telling you is like, oh no, FHA loans are more risky, they just don't know what they are. My favorite line ever is, and I think it was Simon Cowell, funny enough, is that don't be offended when someone tells you no. It's because they probably weren't smart enough to tell you yes. And so that's kind of the mindset I come to when it comes to some of these loan programs that maybe a real estate agent or a seller is like, oh, no, you can't do that. And it's like, do you understand the opportunity it creates for the consumer? Because that's really what this is about. Veterans loans, VA loans, if you're a veteran, active duty or retired, you have access to 0% down. You probably can get away with no funding fee if you have a service-related disability payment. And that's a phenomenal opportunity for our veterans that I think is a very underserved community. And then the down payment assistance programs or the low down payment options, a lot of those don't require you to be a first-time home buyer. So if you've owned in the past, or you own and you're selling and you're buying a new one, you can still take advantage of those. So you can still have an opportunity to get into a home for little down and still start creating some opportunity for you.
Okay, great. Ladies and gentlemen, if you're watching this, don't believe, like you said, your cousin, your uncle, what you read on TV. Talk to a licensed professional that has been doing this for almost 2 decades. Now, what about some unique loan options that you've seen help people? Because everyone, 30-year fixed, 15-year fixed. What are some like unique loan options maybe you've seen over the last few years that have helped people get into homes that they weren't aware of?
I think probably some of the bigger ones that are coming out are going to be like, there's a DSCR loan that is built for an investor that doesn't require, I'm basically just looking at as long as the rental income potential will offset the payment, I can do the loan. I don't need income. I don't need anything else. So that's a great opportunity for investors. There's some down payment requirements in there that you need to be cognizant of. There's some credit score minimums and things like that. But that's an awesome loan program for people who are wanting to get into the market and maybe don't have the income on paper to necessarily support it, but that rental payment will offset the new mortgage payment enough that's a great opportunity. There's also bank statement loans. So we can use like asset depletion or just straight up bank statement loan where like I had the one that I did that was the most memorable for me is a client that I had that was going through a divorce. He had like a little over $1 million in the bank, but it gotten laid off too. But he needed to move because the wife was getting the house, the divorce is final and all this stuff. He's like, I don't have anywhere to go, but I have like $1.5 million in assets. I don't want to pay cash for a house. I'm like, fair. So we were able to utilize the bank statement loan or an asset depletion loan. So you can do one of two things. I can either take your total assets and I amortize it over a 5-year period, and that's your income. Or as long as you have enough money available to cover a couple of months, years of reserves, plus 100% of what the loan amount could be after your down payment's paid, I don't need to verify any other income. So there's some other, like, especially like your self-employed buyers who probably write off absolutely everything because they don't want to pay taxes. It's a great option for them as well. If they've got money in the bank, I can use incoming deposits to calculate what your income is instead of looking at tax returns. So there's some creative options in there specifically for the more unique income-driven client. There's also one that I like is it's called the Family Opportunity Loan. But basically, if you have an aging parent who needs a home and maybe doesn't qualify because the credit's not good or whatever the case is, doesn't have a lot of income, maybe they're living on Social Security, whatever the deal may be, you can purchase the home for them as a primary residence. Even though it's not going to be a primary residence for you, it will be for them. And you can do a low down payment. So you can basically do the loan in your own name. They're going to move into it. That's all documented. But that gives you the opportunity to not have to purchase the home like an investment property or a second home, which requires a larger down payment that maybe we don't have, or putting them on the loan, which might kill your interest rate or maybe you still don't qualify. So that's a great opportunity for like that aging parent demographic. And then am I allowed to say the RM word?
We're gonna get there in a minute. That's one of my big questions. Yeah, we're gonna get.
Okay.
I feel like you and I could do 2 episodes on this. Quite honestly, it's a shame that we only have an hour. Let's talk about AI. I remember for my career, I've been doing this 2.5 decades, 26 years. When the robo advisor came, I was told that go find a new career because robots will be taking over. And here we are, still growing our company because people want that personalized, high level, high touch, someone they can call when crap hits the fan. We're there for our clients. With AI, where you can go in and type, get a lot of information now. From my industry, a person can type in their age and how they should be invested. You can type in XYZ mortgage information and AI within seconds can spit it out. The question is AI going to replace you? Why do we still need mortgage brokers? And what is something that you will always be able to do for your clients that AI or chat will, probably never replace?
I think the biggest thing, no, I don't think AI is ever going to replace me personally. I think there are some people in my industry who it absolutely will replace. I think there's some people who don't focus on the consumer experience because, to your point, there are people who want that personal approach. They want someone to talk to. There is a reason why you yell representative into the phone. It's because you want to talk to a human being. You don't want to talk to that's real.
It is a yell.
Yeah, I'm envisioning an episode of Modern Family where she's just screaming representative. I'm like, God, I hate that because I do that all the time. I was like, I don't want to talk to a robot. I want to talk to a person because I have a specific question that's not dialed into your algorithm. The information that AI spits back is only as accurate as what you give it. So, and I think the best way to explain that is I have clients who will fill out an application online and the data's wrong. They don't know their income. They transpose some numbers on their Social Security number. They plug in an income number they're like, oh, well, no, I have this income coming in. And I was like, yeah, but it's not documented. I can't use it. Right. So there's still too many nuances, I think, in a overall credit profile. And then I think too, on the advisor side, like there's no computer that has empathy. right? Like we can't program that. So if you coming to me and being like my client today, I think if he plugged that in there, they're like, oh yeah, we can save you X amount of dollars if you just do this, and we'll just do a shorter loan term to get you a better rate and the payment will get dropped off. And it's like, okay, but you didn't address the actual issue, which is the escrow shortage. And the fact that he's paying almost $700 more per month than he should be because an algorithm spit out a new insurance policy without talking to him. And so I still think, again, we use an automated underwriting system. That's how we run all of our files through automated underwriting with all the data. And it just verifies, yes, these numbers work. We double check our math. But again, it's only as accurate as the information I put in there. So if I transpose a number, the information's not accurate. And now I don't have an actual loan approval. So I also think the relationship side of things, I think people still want to talk to people.
I agree. I mean, I always say this, like, I don't think the good ones, the good advisors, whether what you do or what I do, are going to get replaced by AI. But I will say that where it's going to come affect us is that if you're not using it to enhance your business experience, processes, like we have fully adopted using AI and chat within our business to help us be more efficient. I won't get replaced by a robot, but I'll get replaced by an advisor or a team or a firm that's using AI. That's the way that I look at it. Like, you got to use it to enhance our business. I agree.
Yeah. I think as long as you adapt to the technology and use it to your benefit, then it still works. But again, it's still the accuracy of the information it's receiving. That's as accurate as your AI answer is going to get.
For sure. We have a lot of chat bots within our processes, within our departments, that we've had to teach it, and we've caught it being inaccurate sometimes. So I totally agree. It's only as good as the information you give it. So now let's go talk about the RM or reverse mortgages. So quite frankly, I got a couple questions. Are they a scam, or do they actually help people? And
Yes.
if you can explain yes to both, or
Yes to both.
Okay.
No, they're not a scam.
Right.
Yes, they help people.
So give us an example of, first of all, what is a reverse mortgage? How do they work? Where can people use it and get in trouble? And where have you seen it be a valuable resource for people, either in retirement or as they're approaching retirement or wherever they used it?
Okay. So you have two options with a reverse. So there's age restrictions on there. It's 60, you have to be at least 62. And the older you are, the more of a benefit you can get, because as morbid as it sounds, if you're 85, you're probably not going to live for another 30 years. So I'm going to give you access to more of the line of credit that you might have on your home. So if you're in for grandma and grandpa who are living in their house, they still have a mortgage, they're on a fixed income, Social Security, and they're paycheck to paycheck, and they're not sure, like they're going to lose the house, this is a phenomenal opportunity for them, because we can basically use a reverse mortgage and we can either tap into the equity and get them a cash, like a lump sum from the house, and then, or just completely eliminate the monthly payment. So I used it for I didn't use it, but I used it for one of my great aunt who her husband had died, and she hadn't been working for like 10 years because she'd been taking care of him because he was very ill. And then she was on a fixed income of like $1,000 a month, and the house payment was $25. She's like, I'm going to lose the house. I don't know what to do. I can't get a job. I'm too old. All of the things. We did a reverse mortgage. She doesn't have a house payment anymore. We were able to get her a lump sum cash. And so now she doesn't have to worry anymore. So it's great to eliminate, especially those clients who are on a fixed income. You can also use it to purchase. So if you have, if you're like, we did this for my mom's mom when she moved here from Arkansas. She had like $500,000 or something from the sale of her house in Arkansas, and she was going to buy something here. She didn't want to use all of it, but she wanted to buy another house. She didn't want to rent. And so she put down, I think she ended up putting down like $300,000 on a townhouse here. And then she just had a loan for the rest. And so the reverse part is, it's just, instead of you paying interest on the loan each month, it's accruing interest. So the interest that you would have paid just gets added onto the back of the loan. There's a lot of stops on there that make sure that you're doing it for the right reasons. There's the consumer has to do a counseling to make sure they're of sound mind, to make sure that we're not trying to get them to do something they shouldn't be doing. So making sure there's no elder abuse. And then you're never going to be in a negative equity position. So they're not, I think that's the big thing that I always hear is like, oh, they're going to take my house. Like, they're not going to take your house. No one's taking your house. You're never going to owe more on the house than what it's worth. And then all that happens is if, okay, I have a reverse mortgage on my house, I'm 99, I die, there's still a reverse on there. In the next 6 months, the estate needs to either refinance the house into a traditional loan into whoever wants to take the house, or you sell it. And then you pay off the loan that's on there just like you would any other loan, and then you get the proceeds. So it operates the same way. It's just the interest is reversed. So I'm not making a payment on a reverse. I'm making a payment on we call it a forward. So that's all it is. I think it's not the right product for everybody. 100%. If you need access to the equity in your house and are on a fixed income, it is a phenomenal option for you. If you need to not have a payment anymore, it's a great option for you. And it's worth at least a conversation.
Yeah, I totally agree. I mean, we generally deal with people with a certain amount of net worth. Mortgage is generally paid off. They've got enough, income, assets, Social Security, pension, distributions, whatever. But for people that maybe are on a fixed income, maybe have a lot of equity and rather really live a better life, maybe in retirement or whatever, and they're not maybe so concerned about what they pass to their kids. Is that what I'm kind of hearing? That's when maybe a reverse mortgage could be a good conversation, or no?
Yeah, and I think that generation today is like, because I still see it quite a bit. They're like, oh, I just want to pay my house off. I want to pay my house off, and I was like, okay, but then what? Like, you have all this equity in the house. Like, what's the plan? Like, if it was my mom or my grandparent, I would much rather you were comfortable and not worried than you leaving me $100,000 when you died. I don't need the money. I don't want it. Like, I would rather you were happy and taken care of and not worrying and not eating. If a reverse mortgage made sense to you, like, that makes more sense to me. It's like, no, you earned that house. You earned that equity. You earned that money. Like, you spend it. I mean, yeah, okay, of course I want $100,000. Everybody wants $100,000, but like, at your well-being is way more important to me. And so that's where I think people think someone's going to take their house, and that's absolutely not the case. And I think people think they're going to be upside down in it and all of these things, and that's just not it. So it's a very niche product. It's for the right person. But again, I think it's absolutely worth a conversation, especially for somebody who maybe they've got a ton of assets. Because I had a situation like this earlier in the year where they have a ton of assets. They don't owe anything on the house. And they're like, well, yeah, they're in their 70s, I think. And they're like, well, yeah, we're just going to take all of the assets and we're just going to pay the house in cash. And I'm like, because they wanted to buy a new house. I'm like, why? Why? What's your income then? Because then that's my next question. I was like, okay, well, so then what are you living off of now? Because you still have stuff. You have gas, you have groceries, you have medical, you have all of those other things. Like, God forbid there's an accident or you need long-term medical care. So then it comes into the whole picture and what can we do to help kind of thing.
Okay, good.
Like, it also feels weird to put a 70-year-old into a 30-year fixed mortgage. Like, that makes me be very uncomfortable. Because I just feel like I'm just like riddling you with debt for the next 30 years. So then it's like, can we at least explore this and see if it makes sense?
Okay. No, it was a great answer. I get that question all the time. Okay, a couple more questions before we wrap up. If you could go into, let's say, what is a 16-year-old sophomore? Say you were to walk in as a guest speaker and talk to a bunch of 16-year-olds. If you could teach them one money-saving tip, one lesson that could change their life, what would you talk to them about?
Compound interest.
Okay. Explain that one a little bit more.
Like saving, I'd make them read a book because that's how I grew up. It's like, you have to read, it would be The Richest Man in Babylon because that's what I had to read. Okay. But it would really just be about paying yourself first and not spending all of your money, like just put 10% away. Because I think if you can develop that habit at 16, you are golden. But if you don't learn that lesson until 35, we've got some catching up to do. So I think not living outside of your means and paying yourself first and making sure that you have that emergency reserve. I think that would probably be the biggest thing.
Yeah, I love that. When we've talked to clients and their kids and their beneficiaries so often. If you saved $100 a month at 18 for 30 years, averaging 6%, versus if you started at 25 or 35, the best attribute or the greatest asset you have is time, and compounding interest over time has always proven to be valuable. Last question. I really appreciate your time. We got a ton of content. I know our viewers that are listening to this are going to really appreciate the transparency and the conversation that we've had. BAM Advisory Group, obviously what we're known. If people were to say, hey, David, what do you do? People, I think, understand that, we're financial planners. We help people with their investments, their retirement, their insurance needs, taxes, whatever it is. But what we're known for is protecting what's priceless. People's time, their energy, and their family. If I were to ask you, Jacalyn, this question, what does protecting what's priceless mean to you in both your life and your business? How would you answer that question?
I think it's like peace of mind. I think it's knowing that I don't have to worry. And like everything's in the right place. I've invested where I've supposed to. I've got the right guardrails up where they need to be. And just making sure that like the decisions that I've made are the best ones for my situation, and just making sure that every decision that I make is in alignment with my long-term goals. So yeah, I think it's just that peace of mind, because I joke that I'm like, I sell peace of mind because that's kind of what I do. It's like, I want to show you how to do this in a way that makes sense, is not pressured, and that I will do what I say I'm going to do, both for the consumer and my referral partners, where it's like, if I say I got it, I got it. And if I say you can do it, you can. And I think that's where it's just like, it's like you can trust me. And so I think that's just like, I trust that the pieces I've put in place, the advisors that I've put around me are always looking out for my best interest. And I know they will help me make the best decisions based on my long-term goals and not their own benefit.
Awesome.
That makes sense.
Did
I answer the question?
No, well, first of all, there is no wrong answer. And, protecting what's priceless means to you is like, decisions I've made are serving my family and myself long-term. And there is no, like, peace of mind is so important for people when it comes to their house or their wealth. And I think making sure you have peace of mind, there's no price tag you can put on that. I think that's a great answer. So anyways, I feel like we could talk for hours. Thank you again. You've been a great friend, a great advisor to our clients, to our team, to me personally. And just can't wait to get this episode out into the universe.
Yeah,
thank you so much.
My pleasure. I appreciate the opportunity to chat. It's fun.
If you're curious about how we help people protect what matters most in their retirement, and you just want to see how our process works for you, give us a call or visit our website at www.bamadvisorygroup.com. You can schedule a 15-minute, no cost, no obligation, no pressure phone call with one of our advisors to get all of your questions answered, to understand your options, and for us to be able to provide you with more information and clarity. And if you're enjoying the show, don't forget to like and subscribe. Thanks again for watching. We'll see you all real soon.